What happens to your money when your spouse dies? It's not a pleasant topic to think about. Most couples would rather focus on enjoying retirement than planning for the possibility of losing a spouse. But here's the reality. For many married couples, the death of a spouse creates one of the biggest financial transitions they'll ever face. And what surprises people is that the financial impact can be significant even when there are plenty of assets and no immediate money concerns. In fact, many surviving spouses experience a situation where their income drops while their taxes increase. I'm Josh Duncan, partner at F5 Financial Planning, where we take a fiduciary approach to maximizing our clients' wealth. In this video, I'll walk through 5 major financial changes that often occur when the first spouse dies, why these changes catch so many families off guard, and what you can do today to better prepare for the surviving spouse's financial future. Let's start with one of the most immediate changes, Social Security. Many married couples receive 2 Social Security checks each month. Over time, those checks become an important part of retirement income. What many people don't realize is that when one spouse dies, the surviving spouse doesn't continue receiving both benefits. Instead, the surviving spouse keeps the larger benefit and loses the smaller one. Let's look at a simple example. Suppose a husband receives $3,000 per month from Social Security and his wife receives $2,000 per month. Together, they're receiving $5,000 every month. If the husband passes away first, the wife would continue receiving the larger $3,000 benefit, but the smaller $2,000 benefit would disappear. Household Social Security income falls from $5,000 to $3,000 per month. That's a 40% reduction in Social Security income overnight. Now, some expenses may decrease when one spouse passes away. There may be lower travel costs, food expenses, or entertainment spending, but many expenses don't change very much. In fact, 70 to 80% of the expenses remain the same. Property taxes are still due, insurance premiums continue, utilities still need to be paid, home maintenance doesn't disappear, and as a result, many surviving spouses discover that their income doesn't go as far as they expected. This is one reason Social Security claiming decisions can be so important. The higher benefit doesn't just matter during both spouses' lifetimes, it may eventually become the survivor benefit as well. The second change is one that surprises many people: taxes. When both spouses are alive, they typically file a joint tax return. Joint filers benefit from wider tax brackets and more favorable income thresholds throughout the tax code. But after a spouse dies, the surviving spouse will eventually begin filing as a single taxpayer. This creates what many planners refer to as the widow's tax trap. Here's why. Imagine a retired couple with pension income, Social Security income, and distributions from retirement accounts. After one spouse dies, some income may disappear, but often a surprisingly large portion remains due to only an expense reduction of 20 to 30%. The pension may continue at a reduced level, investment income may stay roughly the same, retirement account withdrawals may remain necessary, required minimum distributions will continue. The problem is that the tax brackets shrink dramatically when filing as a single taxpayer. So the surviving spouse can end up paying higher tax rates on income that isn't much lower than before. I've seen situations where people assume taxes will automatically fall because there's only one person left. In reality, the opposite can happen. The surviving spouse may find themselves in a higher effective tax situation despite having less household income. That's a difficult conversation. Less income, higher taxes, and fewer opportunities to adjust after the fact. The third change involves healthcare costs, specifically Medicare premiums. Many retirees are familiar with something called IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. In simple terms, higher income retirees can pay higher Medicare premiums. When a couple files jointly, they are measured against married filing joint thresholds. When the surviving spouse begins filing as a single taxpayer, the applicable thresholds become much lower. This means a surviving spouse can find themselves crossing an IRMAA threshold even though their income hasn't changed dramatically. The result can be higher Medicare premiums on top of potentially higher income taxes. Again, notice the pattern. Income may decrease, taxes may increase, healthcare costs may increase. None of these changes are typically caused by bad decisions. They're simply consequences of how the rules work, but understanding them ahead of time gives you an opportunity to prepare. The fourth change involves retirement accounts. Many retirees have accumulated substantial balances in traditional IRAs or employer retirement plans. Those accounts often represent decades of diligent saving. When one spouse dies, those retirement accounts don't suddenly become smaller. The surviving spouse may inherit the account and continue managing those assets. But here's the challenge: the required minimum distributions continue, the tax consequences continue, and the account balance may still be large relative to the survivor's income needs. Imagine a couple with a sizable IRA balance. While both spouses are alive, they may be comfortable taking distributions as needed and managing taxes together. After one spouse dies, the survivor may still be forced to withdraw substantial amounts from those accounts. Those withdrawals can create taxable income. A taxable income can affect Medicare premiums, and it can contribute to the tax challenges we discussed earlier. This is one reason tax planning before retirement and during the early years of retirement can be so valuable. For some families, strategies such as Roth conversions may help reduce future required distributions and create more flexibility for the surviving spouse. Of course, every situation is different, which is why these decisions should be evaluated carefully with your financial planner and tax professional. The key takeaway is that retirement accounts don't automatically become more tax efficient when a spouse dies. In many cases, the surviving spouse inherits the same tax challenges, but with less favorable tax rules. The fifth change is one many people overlook. The surviving spouse suddenly becomes responsible for carrying out numerous financial and legal decisions. This is where estate planning becomes incredibly important. Think about everything that may need attention: beneficiary designations, trust documents, powers of attorney, investment accounts, bank accounts, insurance policies, property ownership. Many couples divide responsibilities during retirement. One spouse handles investments, the other manages household finances. One may oversee taxes while the other takes care of insurance and estate documents. When one spouse passes away, all of those responsibilities often fall on a single person. That's why organization matters. One of the best gifts you can give your spouse is clarity. Make sure important documents are accessible. Make sure beneficiary designations are up to date. Make sure both spouses understand where assets are located and how household finances work. I've worked with many surviving spouses over the years, and one common theme emerges. The families that transition most smoothly are usually not the ones with the most money. They're the ones who prepared. Preparation reduces stress. Preparation reduces confusion. Preparation creates confidence during an incredibly difficult time. At this point, you might be wondering what steps you should take. The good news is that many of the best planning opportunities exist while both spouses are still alive and healthy. Start by evaluating your retirement income plan. What would happen if one Social Security benefit disappeared? Would the surviving spouse still have enough income? Next, review your tax situation. Could future tax brackets become a challenge for the surviving spouse? Would Roth conversions or other tax planning strategies improve flexibility? Review your Medicare planning assumptions. Understand how future income levels could affect healthcare costs. Take a fresh look at your estate plan. Confirm that beneficiary designations align with your wishes. Make sure legal documents are current. And perhaps most importantly, have conversations together. Many couples avoid discussing these scenarios because they're uncomfortable. But planning isn't pessimism. Planning is an act of care. The purpose isn't to focus on loss. The purpose is to ensure that whoever survives has the resources, organization, and confidence needed to move forward. When the first spouse dies, several important financial changes often occur. One Social Security benefit may disappear. The surviving spouse may move into less favorable tax brackets, Medicare premiums can increase, and retirement account distributions may continue creating taxable income. And estate planning responsibilities become more important than ever. The goal isn't to worry about these possibilities. The goal is to prepare for them. The best plans don't just help couples retire successfully together, they also help ensure that the surviving spouse remains financially secure if life doesn't unfold exactly as expected. Thanks for joining me today. If you would like to learn more about how F5 Financial Planning helps our clients achieve financial freedom for personal significance, please visit our website at www.f5fp.com.